Want guaranteed income for your family? In this video, we'll cut through the jargon and show you what Aditya Birla Sun Life's Nishchit Aayush really does, and whether it actually works for goals like education or retirement. Let's dive in. Nishchit Aayush is designed to give predictable financial support. It's not market-linked. Returns and payouts are governed by the plan's fixed factors and options. Its core purpose is to deliver a reliable income stream and a guaranteed lump sum at maturity, along with life cover during the policy term. Think of it as a structured way to meet long-term responsibilities such as children's education, retirement top-up, or maintaining your standard of living with a steady income. The plan is built in 3 main steps. Step 1. Choose a benefit option, either long-term income or whole life income. Step 2. Pick an income variant, for example, level income, increasing income, return of premium, income only, or an enhanced lump sum option. Step 3. Customize timing, when your income starts and how frequently you want payouts. Remember, these core choices are made at policy inception and cannot be changed later, so choose carefully. You must choose one benefit option at the start of the policy. First choice, long-term income. This provides income for a fixed policy term, typically from 15 up to 40 years, and is ideal when you have a defined time horizon, for example, funding education or repaying a loan. The minimum entry age for long-term income is 30 days, and the maximum entry age is 65 years, with a maximum maturity age normally 85 years. Second choice, whole life income. This provides income up to age 100, making it suitable for legacy or long-term retirement top-up goals. For whole life income, the minimum entry age shown is 30 years, and the maximum entry age is 55 years, with maturity age up to 100 years. Choose the option that matches whether you want income for a fixed period or income for life. Next, you choose an income variant, which determines how your income and maturity lump sum behave. The common variants include level income with lump sum, steady regular income, plus a guaranteed lump sum at maturity. Level income with enhanced lump sum, steady regular income, plus a higher guaranteed lump sum at maturity. Increasing income, payouts increase at a simple rate, for example, 5% every 5 years, to help beat inflation. Return of premium, same regular income, but a larger lump sum at maturity intended to return your total paid premiums. Income only maximizes regular income. In this variant, there may be no lump sum at maturity. Each variant changes both the regular income you get and the guaranteed lump sum factor, so the choice matters for your long-term cash flow. Now, let's fine-tune the timing. You can choose to start receiving income immediately or defer it for up to 5 years. Generally, waiting a bit longer results in higher income payouts. You can choose to pay for 6, 8, 10, or 12 years, and you can pay annually, semi-annually, quarterly, or monthly. You can also choose how often you get paid. If you choose monthly, you receive 8% of the annual amount each month. Quarterly is 24.25%, and semi-annual is 49%. This plan also provides a safety net for your family. If the insured person passes away while the policy is active, a death benefit is paid as a lump sum to the nominee. The benefit is the higher of the surrender benefit at that time, or the sum assured on death. The sum assured on death is the higher of a multiple of your premium, 5x, 7x, or 10x, or 105% of the total premiums paid. Nominees can also choose a staggered payout, receiving the benefit in installments over 5 years, which actually results in a higher total payout of 109%. If you survive until the end of the policy term and all premiums are paid, you get a guaranteed lump sum. This is calculated by multiplying your total premiums paid by a lump sum factor. This factor changes based on your plan. For example, a 12-year payment term for a 40-year policy has a factor of 70%. Just a reminder, the income-only variant does not include this maturity benefit. For extra peace of mind, you can add optional riders at an additional cost. Accidental Death Benefit Plus rider provides an extra lump sum if death is due to an accident. Critical Illness rider provides a lump sum on diagnosis of specified illness. Surgical care rider offers a lump sum for medically necessary surgery. Hospital care provides a daily cash benefit for hospitalization. Waiver of premium rider waives all future premiums if you are diagnosed with a critical illness, disability or death, if the policy is on a minor's life. Transparency is important. So let's talk about exclusions. Suicide clause. If the insured dies by suicide within 12 months of the start or revival, the full benefit is not paid, only the surrender value or total premiums are returned. Waiting periods. Riders usually have a 90-day initial waiting period where no claims are paid. Pre-existing diseases. Conditions diagnosed within 36 months before the start are generally excluded. Common exclusions. Claims from self-inflicted injuries, criminal acts, drugs, alcohol, or hazardous sports like mountaineering are often not covered. Life can be unpredictable, so here's what happens if premiums aren't paid. If you stop before paying for 1 full year, the policy lapses. All benefits and risk cover cease and no value is payable. After 1 year, it converts to a reduced paid-up policy. All benefits are reduced proportionally, and future income stops, turning into a terminal value, paid at death or maturity. Note that the 100% lump sum enhancement is lost in reduced paid-up mode. Also, all rider benefits cease immediately. You do have a 5-year window to revive the policy to its full value. To be eligible to buy this plan, the entry age of the life insured should be between 30 days and 65 years for long-term income, and between 30 years and 55 years for whole life income. The policy term can be between 15 and 40 years for long-term income and 100- age at entry for whole life income. The premium payment term can be 6, 8, 10, or 12 years. Minimum annual premium is 30,000 rupees. Small modal loadings apply if the payment mode is monthly, quarterly or semi-annual. You also need to account for potential extra premiums for high-risk health conditions or occupations. Now let's understand how to access policy value and revive the lapsed policy. After the first year, if the policy has surrender value, you can borrow up to 80% of it. The minimum amount to be borrowed is 5,000 rupees. You can terminate the policy after 1 year. You'll receive the higher of the guaranteed surrender value or special surrender value. You have a 5-year window to reinstate a lapsed policy by paying outstanding premiums plus interest. You may be asked to provide proof of good health. The claim process for your beneficiaries is designed to be clear. Step 1. Notify ABSLI as soon as possible, ideally within 90 days. Step 2. Submit the statement form, death certificate, original policy, KYC and bank details. Step 3. Death claims without investigation are usually settled in 15 days, while those requiring investigation take up to 45 days. Let's walk through Mr. Sharma's example. He's 40 and chooses the long-term income option, paying 1 lakh rupees a year for 10 years, so he pays 10 lakhs rupees in total. The policy term is 40 years. If he survives the term, he receives 34,800 rupees every year for 30 years, which adds up to 13,92,000 rupees in income. At age 80, he also gets a 14 lakh rupees maturity payout, so the total benefit he receives in the survival case is 27,92,000 rupees. If sadly, he passes away in year 15, by that time his family will already have received 4.87 lakhs rupees in income, and they would also receive a 10,50,000 rupee death benefit as shown in the figure. Now let's look at Mr. Singh's case. He's 40 and chooses the whole life income option, paying 1 lakh rupees a year for 10 years, so he pays 10 lakhs rupees in total. If he survives to age 100, he receives 35,750 rupees every year, and at age 100 he gets a 25 lakh rupees maturity payout. That brings his total benefit in the survival case to 46 lakhs 45,000 rupees. If he sadly passes away in year 15, his nominee receives 10 lakhs 50,000 rupee lump sum, in addition to any income that's already been paid out. The key question: is this plan a good fit for you? This plan may suit you if you want guaranteed predictable fixed returns instead of market-linked uncertainty. It's a good option if you need disciplined savings, combining long-term savings with life cover in a structured way. If you are planning for long-term goals like a retirement corpus or creating a legacy, this plan is built for that horizon. And if your main objective is a regular income stream, it can provide steady supplemental income. On the other hand, consider alternatives if you are seeking higher growth and are comfortable with market risk, such as mutual funds. If you need high liquidity or easy access to funds, this plan may not be suitable. Exiting early can mean losses. It's also not ideal for short-term goals like 5 to 10 years. And if you mainly want pure life protection, a term insurance plan can offer higher coverage at a lower cost. FAQs and the fine print. Can I change my benefit option or income variant later? No. Those core choices are made when you buy the policy and are permanent. Are the benefits truly guaranteed? Yes, but only if you pay all due premiums in full and on time. If the policy becomes reduced paid up, the guarantees change. Is the payout tax-free? Generally yes, but note this update. For policies issued after 1st April 2023, if your aggregate annual premium across all life policies exceeds 5 lakhs rupees, the maturity proceeds may be taxable. Please check with a tax advisor for your situation. A few important terms to remember. Free look period. You have 30 days from receiving the policy to review it. If you disagree with the terms, you can return the policy for a refund, minus small deductions. Grace period. If a premium is missed, you have a short window to pay without the policy lapsing, typically 30 days for most modes, and 15 days for the monthly mode. It's crucial to approach any financial decision with careful consideration. First, take your time to thoroughly assess your current financial situation. Next, clearly factor in your personal risk tolerance, your specific income needs for the future, and your overall long-term financial goals. Most importantly, we strongly recommend talking to a qualified financial expert. Their insights can help ensure you are making the most informed and suitable decision for your unique circumstances. Thanks for watching. Check out the video description. We've packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.